Hey, good afternoon, everyone. Tom Gucci here with the Mortgage Collaborative. Time is now 4 p.m. for those joining on the East Coast, cascading across the country just after 1 o'clock for those joining on the West Coast. Give a brief moment here as our attendees continue to filter in for today's discussion, but want to welcome everybody for today's TMC Connect web broadcast entitled The So What of Q1 2021, kind of diving into volumes, margins, and cycle times, and really designed to kind of advance your 2021 strategy with Q1 market data. And unique part about this discussion is it'll be more focused towards the West Coast. And it's led by our partners with FBX Informa Financial Intelligence. So just before kicking off, I have a couple quick ground rules I will dive into, and then we'll go ahead and get the discussion started. But quick reminder for our attendees, we also had a similar discussion focus more so on the East Coast metrics from Tuesday of this week. So as part of the follow-up to this group, we'll also include a copy of that deck as well as a link to the on-demand recording. So if you've got a footprint out there that spans across the country, should be some really interesting insights from that discussion that you may want to hone in on or share within your team as well. Quick shameless plug from the collaborative side, just encouraging attendees, keep checking out our TMC Connect and member event calendar sections of our website through the mortgagecollaborative.com just for an upcoming schedule of TMC Connect web broadcasts. Additionally, registration is open for our return to in-person events dubbed Reunited TMC Summer 2021, and that's going to be at Terranea Resort in Southern California, September 18th through the 21st. So information now available and open registration on the Collaborative's website. So look forward to seeing you back in the flesh this coming September. Real quick for today's call, whether you've dialed in or you're connected via your computer, all lines have been muted, done only to avoid any background noise in your area and just ensure that everybody can hear today's presentation clearly. Now, that said, we do want these discussions to be as interactive as possible. So any questions, comments, hell, even if you want to send us a shout out from where you're listening in from today, feel free to drop that information in the chat. And I'll be able to verbalize any questions, comments that you have for our discussion leaders today, just towards the end of our call. And if you're wondering how you do that, well, bottom menu of your Zoom screen, you'll see both the Q&A and chat icons. Feel free to click on those and submit in any questions, comments you have, and I'll relay those on your behalf. As I kind of alluded to, today's call is recorded and will be available for playback. So links to an access of the copy of the recording as well as presentation deck will be in follow-up email. It should be coming out to the group tomorrow. So on that note, now 3 past the hour, want to jump into today's discussion, which y'all came here for, and introduce our discussion leaders from our longtime preferred partner at FBX Informa Financial Intelligence. You may know them as the One-Time Icon Advisory. Pleasure to have with us Vice President of Client Success, John Sayer, as well as Sales Director of Lending Solutions, Britt Haven.
Good
Hey,
afternoon.
Britt. Hey, John. How you both doing today?
Everyone.
John?
Thanks for having us.
Always a pleasure to have you on. And I know I got some great feedback coming out of Tuesday's discussion out of some of the metrics that you shared with the group on that call. So I'll stop yammering and allow us to drive directly into today's discussion. And yes, Britt, I'm going to turn it over to you to kick things off.
Awesome. Well, thanks so much. Great to have everyone on the call today. Appreciate y'all making some time today. So we'll be covering the so what of Q1 of 2021, volumes, margins, and cycle times. So again, we're going to kind of be covering operational cycle times, what refi cycle times are looking like in this first quarter, monitoring market margins, purchase market trends. Is the market starting to shift from refi to purchase? What is that looking like? And then also the market's reaction to the Gse Delivery Restrictions that we've seen over the last couple months. As Tom mentioned, please make sure that if you have any questions, type in the question box and we'll be able to address them. As he said, all this data, the decks will be available post-call as well. Before we jump into the data, and the full deck. Kind of want to cover a little bit of how we get the data. So as part of our lenders benchmark platform, lenders provide us with their app lock and funding data every week. So every Monday, all of our participating lenders provide us that data. We get it in our system, and so you get to see almost real-time data. So this Monday we got everything through the 18th of April. From a retail perspective, which is what we're going to be focusing on today, we capture about 50% of mortgages originated in the retail market. So again, making that data set, that denominator, a statistically significant number. And it's made up of national banks, regional banks, credit unions, IMBs, kind of all shapes and sizes. And it really allows our clients to understand their market share, understand operational efficiencies, business net mix, price competitiveness. A little bit of the data is also going to be coming from our pricing or rate surveys. So this is also, again, all directly lender sourced. Lenders provide us with their rate sheets every day, so it's updated daily. We've got about 250 lenders that participate across the different retail markets. And similarly to our originations benchmarking data, it's a mix of banks, credit unions, mortgage bankers, kind of everything there. And so to kind of kick it off, John's going to just do a quick Q1 review. John, I'll hand it over to you.
Awesome, appreciate it. Thanks for your attention this afternoon. Just going to look a little bit, give you a bit of market high-level context. We're going to look at two things. We're going to look at the first quarter of this year versus the first quarter of the year before, 2020. And we're also going to look at this year, first quarter. Let's see, this year, first quarter versus last quarter, the fourth quarter of 2020. We tracked, as Britt mentioned, almost half or about half of all retail originations. That equated to about $347 billion in the first quarter of this year. Just as a footnote, all of last year, we recorded about $1.1 trillion of retail transactions. Again, about half of all transactions, so certainly statistically significant. Headline numbers here, we saw a growth, year-over-year growth, first quarter to first quarter of 74% as we stand here today. The fourth quarter, interestingly, last year to the first quarter of this year, we're actually up a little bit to about 2.5% this first quarter. So obviously a lot of loans in pipeline that we're able to fund in the first quarter, representing an increase over the fourth quarter of 2020, despite rates ticking up a little bit. Breaking that down by channel within retail, so branch, which would be decentralized, versus call center, which would be our centralized. Looking at those breakdowns, we did see year-over-year first quarter 53% growth versus call center 117. So almost twice as much growth in the call center environment, not surprising given they're focused on refinance transactions, which we'll see in a moment. Interestingly, in the first quarter of this year versus fourth quarter of last, branch environment down a little bit, 4%, benchmark up 14% for that call center. So a lot of that refi overhang still getting funded in the first quarter. Breaking down by financial institutions, you can see the numbers there. Year over year, financial institutions just were not able to keep pace with the amount of 24/7 operations perhaps that mortgage banks had in place, with mortgage banks doing 3 times their market growth year over year. But quarter over quarter, they're almost flat. So that's a big difference, 0% versus up 4%. From a purchase standpoint, we see about 28% of transactions in the first quarter getting done in purchases. That was up 33% year over year. We did see quarter over quarter that down 22%, but that's really a more evidence of cyclical, purchase transactions being down this time of year. We expect that to rebound greatly in the next quarter. And then you see the breakout for rate and term and cash out. So we give you both a mix of business assessment on the left, and then that year-over-year view for each product purpose, and then our quarter-over-quarter view in the far right. Same information here, but we're looking just first quarter over first quarter, year over year for the West folks, West Coast folks, or Western U.S., I should say. So you can see the states that are represented here. The overall national number, you may recall, was 70. I think it was 76% year over year, 66% year over year for the Western U.S. So a little bit less growth in the Western U.S. as we experienced nationally. The other numbers break out there, and you can certainly, we'll get this as a follow-up, and you can stew over those numbers at a future time. And Rich, you're going to hit cycle times.
Yes, thank you much, Sean. All right, so operational cycle times. So we are looking here at refinance cycle times, because obviously refis are where you've kind of got a little bit more of the control. This is a look over the past 2 years. So from January of 2019 through March of 2021. So a little over 2 years, I guess. And, you know, obviously you can see here that purchase or refi volume has continued to climb up over the last year. And obviously, you know, cycle times did creep up a good bit, but they are starting to kind of come down, stable out a little bit as we get to the end of this end of Q1. Again, as I think we start to see a little bit of the volume start to shift from refis to purchases, as well as just you know, more lenders are kind of getting caught up and clearing out inventory and have a little bit more capacity in their pipelines to get these turn times down a little bit lower. Again, this is just all refis, kind of at a high level look for the last couple of years. Then here in the next few slides, I've broken it down by conforming, government, and non-conforming to just look at for the last quarter, kind of what turn times have looked like. Again, this is for refinance data. And this is looking at it from a national standpoint and just doing kind of a quick snip here. So you'll see that for conforming refi, started way up at, you know, a little over 76 days, come down quite a bit towards the end of February, ticked back up a little bit, but now holding at about 73 days here. For government refis, we're seeing they're about 20 days slower than, or excuse me, 20 days faster than conventionals, and kind of following the same trend, just a little bit more of an exaggerated swing here. They got down a good bit lower in late February, early March, jump back up mid-March, late March, and kind of stabilizing out the last couple of weeks. The non-conforming, obviously these had the longest turn time average, active fund average, up at almost 100 days. You know, towards the end of even last year, we saw well over 100 for a lot of markets. But obviously, again, as more financial institutions are picking up capacity as volume starting to settle down a little bit, these have come down by come down to like just over 80 days.
All right, so we hit door number one there was operations. That was really the hot topic among our clients last year. You know, hey, my cycle times are running 40, 50, 60, 70, 80, 90 days for refinances. Is that good or bad? And hopefully we gave you some context around that, and also what's occurred in the first quarter of this year. Again, so what? Things have leveled off a bit, but things are much greatly elevated historically in terms of cycle times. And the second topic I would say that we're really transitioning into here in the first quarter with rates ticking up a bit is margins. You know, what kind of margin pressures are we seeing in the market across products, across different geographies, across different business channels? We're focused today on retail, so we're going to give you some insight here into rate lock information. So this is not just where people are advertising rates, which of course we have as well, but this gives you a view into the top 5 purchase products that we are tracking locks this year. And we can see from the outset of the year up until a week ago what we're seeing for average rates for each of these product types. And the so what on this screen here, I think, is really the non-conforming, the thick blue line there, starting the year about 2 7/8 note rate, and then continuing up to about 3 1/8 average note rate as we stand here today. That's about a 1/4% increase, but you will note that it has not increased nearly as much as conforming 30-year fixed, which has trended towards from 2 3/4 at the beginning of the year up into 3 3/8. So we saw about a 0.5% average rate increase on conforming versus about a 1/4% rate increase on non-conforming. Lots of different reasons around that we could talk about, but I do think as whether you're hitting the Chrisman report or what have you, you're seeing a lot of energy lenders are putting into non-conforming loans as they now get after, hey, the conforming loans were the easy ones to do, non-conforming not as easy, but hey, I got room in my pipeline, so let's get after some of these non-conforming jumbo loans, get my product offering more robust in that regard. So you do see a lot of price competition there now. Next slide. Okay, so we're going to look at 3 different views, similar to what Britt did. We're going to look at conforming, Govy, and non-conforming, and we're going to look at rate trends for each of these products, and then we're going to look at what locked in the prior week. We're going to look at a note rate distribution. So the top graph here, again, is year-to-date average rate that locked in for purchase transactions. And the other big topic as folks look to shift from potentially a refinance market to focusing more on purchases, we just want to give you some additional insight into the purchase side of things. So this is for purchase only right here. We see average rates trending up for conforming. You can see that there on the top. What I think, though, is really interesting is to do a deeper dive into what note rates are getting locked in, and then, of course, how your locks are comparing to those. In this instance, we see for conforming purchase transactions, about 3 1/4% being the predominant rate there, with about 24% of loans getting locked in at that rate. The next slide on purchase transactions for Govies, again, you can see the trend there on top. A much greater dispersion of note rates, and it has implications, all kinds of different implications around the loans you may retain in servicing, to different price strategies across FICO bands, the loan amount bands that result in a much greater dispersion of note rates. So there is, and our clients spent a lot of time focusing in on note rate strategies for government loans, because you can see in refinances and purchase transactions here that we're seeing that there can be some favored note rates, if you will, and where people will pay most of their attention to maybe look at different margin strategies across different note rates. Back in the day when I spent a good part of my career at Fannie Mae, we used to absolutely have note rate strategies with buy up and buy down grids, and we're seeing a lot of that on the margin management side of things for government loans. And then finally, I mentioned non-conforming at the outset here, 30-year fixed at the top there. Rate trends gives you a good sense of, hey, where are you getting things locked in right now? Where's the market getting things done? Perhaps you're wondering, I heard somebody locked in a loan last week at a 2 3/4 note rate for a jumbo. Is that true or not? Yes, it is. There were a few loans done at that level, but maybe 2% of the market getting done at that lower note rate. Where are the predominant note rates getting done? In that 2 7/8 to 3 1/4 range, where we see most of the business getting closed, with 3 1/8 being the predominant note rate, with 21% of the business. And finally, just on the margin management topic, whatever source of rate information that you get, whether you're looking at competitors' websites, whether you're using our rate surveys, whether you're working with your hedge firm or any other price providers, you know what your margins are, you know what the average rates are that you're locking in, and having that ability in this yellow line to compare and see where the loan's getting done away from you in terms of locks. We see in this lender's instance, their average rate diverging from the market average rate as other competitors perhaps get more aggressive in this instance. And margins, you can surmise then that margins contracting away from you if your margins aren't changing, but your distance from market average is.
All right, so now we're going to kind of shift further into and do a little bit of a deeper dive into the purchase market, as obviously the market is shifting from refis to purchases. Kind of look at some of this data. So this right here is just a kind of graph of all purchase volume, and it's doing the last 12 months. So Q2 of 2020 through Q1 of 2021 compared to, in green, the prior 12 months. So Q2 of 2019 through Q1 of 2020. And just kind of seeing how they line up. What's interesting is this kind of just shows, you know, that purchase market is cyclical. While the volume this year has obviously significantly exceeded the prior year, you notice the lines are pretty much trending, just a larger volume this past year. Kind of looking at this in a few different ways. This is looking at year-over-year funded volume for purchase transactions only, and just kind of breaking it out by conforming, government, and non-conforming. You know, it's like conforming volume fixed rate is up significantly from the prior Q1 of 2020. What's also interesting is non-conforming volume, especially on the fixed rate, is up significantly and actually up over government fixed rates for purchases right now. Again, this is looking at it from a national level, year-over-year funded data. And this is just kind of taking that data in a graph format. So again, you know, following in line with that 2-year trend too, you can see that this quarter compared to year-over-year, so Q1 of 2020, volume is very similar, or trend is very similar, just volume is significantly larger. And this is looking at locks. We looked at funding, you know, what's happened, and then locks is, you know, what's happening right now. So you'll see here, there's even a, you know, with the non-conforming fixed rate, there's even a larger, you know, increase in larger volume there than in our fixed rate govies. And then obviously conforming fixed rates are up significantly compared to Q1 of 2020. And then here, again, you'll see the volume is up, trend is very similar. This is looking at retail volume for the first quarter here, just by state. And again, this is based on our benchmark, which makes up about 50% of loans originated. But this is the top states funding volume for our benchmark. So you can see, no surprise, California, Florida, Texas are up at the top with the largest funded volume in purchases for the Q1. Right now, kind of splitting it out by products here. This is just showing the top 15 products nationally that were funded in Q1. So I mean, no surprise that, you know, conforming 30-year made up a vast majority of the volume. But obviously, you know, you see here a lot of non-conforming jumbo business, agency jumbo, non-conforming, ARMs are in there. So, you know, a lot of non-conforming and jumbo business is being happening right now. Then just kind of showing you a little bit different cut of that data. You know, here, this is across the entire US. The next slide we'll have is just for those Western states, but just kind of showing you the top handful of products and kind of the distribution of our benchmark, the units in volume change, average rate, and loan size for Q1 funded purchases in the US. What's interesting is that agency jumbos are up by, you know, 111% year over year, which is pretty significant. And these are obviously the largest volume products. But what I do think is interesting and not on this slide though, is that a lot of the non-conforming IOs and non-conforming arms less than a year are up by a substantial amount. Some of them are up by over 100%, 600%. So while they make up a very small percent of the overall volume, their growth is significant. And then this is looking at it specifically for those West Coast states, or I should say Western states, falling pretty much in line with, from a product standpoint, largest volume products. Agency jumbo here is up by 100%. So it's up a little bit less for those Western states than nationally. But again, pretty much the same set of products in that top products. Then we're going to take a look at it from a state perspective. And we've broken it down here by state. Within our data itself, we can get as granular as zip code. So again, for this, we're kind of going at that 10,000 foot view. But you can really slice and dice the data and get very, very drilled down into things. So again, we're looking at a state level, but you can get as granular as down to a zip code. So this is kind of just looking at all purchase products, all purchase volume across those Western states, and looking at just from which states had the largest volume growth. And that just included, the average rate and the average loan size, just from more of an FYI perspective. Obviously, these states that had the largest growth, Alaska, Wyoming, California. California is, also one of the largest volume-wise. But Alaska and Wyoming don't make up as large of a percent of the volume, but have had the most significant growth in this last quarter compared to Q1 of 2020. And then this slide just kind of breaks it down by product group. So conforming, government, non-conforming, again, just looking at the Western states and kind of filtering it by the largest volume change. So for conforming, Hawaii, California, and Alaska are all largest growth there. For conforming govies, Alaska, Wyoming, New Mexico. It's interesting, for govies, Alaska's volume change is up by over 110%, and you'll see everyone else's growth is significantly less than that. And then same with the non-conforming on the Wyoming side, it's up by 130%. The closest next is Utah at 75%.
Britt, I'll tell you what's jumping off the charts to me was that stat on North Dakota's non-conforming average loan size. I'd love to know how many loans contributed to that at 1.4 million. That's kind of crazy.
Yeah, it is. It's the data is really, really interesting. Again, we're kind of just giving you guys a snippet shot of it, but there's a lot you can see within the data, and really can tell a lot of different stories. And with that, John, I'll kick it over to you to look at the Gse Delivery Restrictions.
Yeah, so speaking of hot topics, market reaction to Gse Delivery Restrictions. I guess it slipped earlier and mentioned that I had been at Fannie Mae a good number of years, but it's been a good number of years since I've been there. So don't have special insight into all this, but we do have some insights to share with you in terms of what we're seeing on delivery percentages for non-owner second homes. But just again, in context here, we looked at cycle times, big topic last year, still a topic this year. We looked at the purchase market. So hopefully some good data that Britt shared with you there as well to benchmark yourselves. Hey, my purchase, you want to defend your turf on purchases, right? So understanding what that means, we just went through. And then of course, watching margins, but delivery restrictions has been really the maybe a more immediate issue for a lot of lenders. So we're going to dig into that a little bit, just a couple slides that you might find informational here. So when you think about the second home and investor, that yellow line being the 7% line, where think of that as the cap or the target or whatever we want to call it for that combined delivery percentage. For lenders that are delivering more than that, obviously a bit of an issue going on. We see from our benchmark standpoint, which would be the overall benchmark. Again, we're tracked over $1 trillion last year, so we have a pretty good sense of what the market is running. You can see if you go back to April of last year, the market was running just right around 7% for combined non-owner and second homes. And then that increased a bit in July, August, up to around 8% and held there for a good period of time up until the end of the year. Then we started to see that shift up a bit even more to about 9.5% over the last couple months. We do see it sort of maxing out there in that dotted blue line. You see it maxing out around 9.7%. And shifting down a little bit in the latest few weeks. And we expect those locks, this is rate lock information, to continue to drift down a bit. But lenders, as we stand here today, are locking a percentage of loans greater than what the GSEs will accept. So think about that a little bit. Obviously, folks on their rates, their rate sheets have made adjustments in pricing. Some people haven't made changes. Some have changed half a point, 2 points. We do have some lenders that have had unexpected surprises in terms of locks and maybe people rushing to the door to get their deals in. So let's look at, first we looked at locks. Now we're going to look at funded loans. So this is actually what funded, not what locked. Obviously, locks are going to tell you what's going to happen, and funded tells you what did happen. If we then go back to April of last year, we were funding about 6% on that dotted blue line. About 6% of loans were funding with that non-owner second home, combined. That shifted up to about 7%. You can see now it's even running towards 9% for funded loans. So funded loans obviously are the cake is already baked a little bit there with loans in pipeline. And so we're not seeing a dip down on funded loans yet. Presumably that will happen as locks contract. So just want to give you guys a good sense, perhaps your own pipelines you're monitoring to see what your percentages are. This gives you a good sense of where the market is generally. So if you're running right now about 8 or 9% of your locks or fundings coming in at the non-owner second home property types and or purpose types, then you're consistent with what others are doing. But that doesn't really solve the issue with the GSEs, and I know that's a interesting hot topic right now. So basically, when you just add to what we went through here today, the whole idea is to get transparency into your performance, right? So whether it's what's my mix of business for non-owner second homes? Hey, how are my purchases doing? Hey, I'm up 20% in purchases this month versus last month. Is that good or bad? Maybe you're losing share on purchases and don't know it. Perhaps you're monitoring margins when getting a lot of feedback from the field. What's real and what's not real in terms of what you guys are seeing in terms of competitiveness with others. And then, of course, cycle times continues on refinances to be an issue as lenders had scaled up, gotten capacity, and trying to work through that backlog. But in any of those cases, we do know for a fact that you have many partners in the mortgage industry, TMC being a great example of one that provide benchmarking information. Obviously, we do a bunch of it here, but your other partners, mortgage insurance companies, investors, and such, obviously have a lot of data as well. The takeaway here is just getting that transparency, pulling up every now and again, every couple of weeks, every month or so, to understand where are you sticking out, where are your opportunities, where are your risks in your business if the market contracts, are you optimizing what you ought to be doing relative to that. So that's a quick synopsis of what we went through. Hopefully the data was of use and import, perhaps. And Tom, would love to hear if there's comments, questions, or anything along those lines.
Absolutely. And John, Britt, thank you so much for going through that. I know I was kind of geeking out on a lot of the comparative metrics that you're able to provide on really some intriguing insights on what you're seeing in the purchase market right now. And You hit the nail on the head. Extremely hot topic amongst our lender members with the Gse delivery restrictions, and I think the metrics on those two slides that you revealed, definitely give a bit more color to maybe the potential rationale from the GSEs, kind of based on the lock and funding percentage trends, and how they continue, especially of late, to continue to push up well north of that 7% threshold, and what it looked like more 8 to 9% based on some of the benchmark metrics. But got some questions in-house. Reminder, any questions that our attendees have, feel free to drop them in the chat for me. I kind of try to segment these a little bit. A couple questions in relation to some of the slides you shared. First off, do you expect non-conforming rate trends to be less volatile as more lenders continue to roll out more niche offerings to drive purchase volume?
Less volatile? Well, I don't think they'll be immune to rate changes, but I do think when you get a steeper yield curve situation here where ARMs start to get in vogue, then people have that alternative between, hey, do I do a 30-year fixed at the 3.5, or I'm going to do a 5-year or 7-year or 10-year at a 3%. And as we get a little bit steeper yield curve here, potentially maybe a little inflation in the market, rates tick up, people will be looking for fixed period ARMs. So I do think even if rates are volatile on the long-term rates, 30-year fixed rates, people will gravitate back to fixed period ARMs and take advantage of, yeah, I still want that 3 handle, that 3-point-something% note rate that I'm accustomed to now, maybe even a 2% start rate, a 2% handle. I do think that as rates go up, people will migrate towards those fixed period ARMs.
Absolutely, and that's great insights there, John. Another question kind of directly related to the purchase volume trend slides. Knowing that it's extremely recent, curiosity if any feedback came back to FBX Informa on the noticeable dip in this past week's trend, or the volume metrics, that was like a noticeable kind of divergence from the trend line that it had been following year over year.
Britt, are you able to bring that slide back up so we can?
And that last one right there, Britt, you just passed. Or no, sorry, I think it's on. Yep. I believe that one, yeah, with the noticeable dip compared to the trend line just over the past week.
Yeah, so this is for funded year over year. This is a week-to-week view. So I would tend to say that if you smooth it out on a month funding, because you get month-end fundings, and then the first week of the next month is not a light funding month. So you kind of got to look at this as a overall trend to smooth it out. The main purpose here is to think about it as a year over year type of situation. And almost without exception here, there's 2 different weeks where the volume wasn't higher year over year. So really the so what here is that practically every single week, year over year, we're seeing higher production than we did the prior year. And that's been pretty consistent. Week to week, we will see some volatility, as I mentioned, just given that some loans tend to fund at the end of the month.
Gotcha. Thank you, John. And then a question from my perspective, honestly, I'm curious for you and Britt, having done the Tuesday session geared towards metrics focused on the eastern half of the country. If anything jumped out, I guess, to you both from the comparative metrics, east versus west, if they were relatively consistent, or if there was anything of note that you found to be intriguing that maybe, was
Sure.
consistent with one half of the country versus the other?
Yeah, I'd make a couple observations. One is that New York got absolutely crushed for cycle times on refinances. So New York stuck out extraordinarily differently for cycle times. I would say that California stuck out in terms of it grew less than any major or large state in the country. And a lot of that was really around that a good percentage of the loans that are relevant in California are jumbo loans, and jumbo loans just didn't get done nearly as much as conforming fixed cookie cutter type loans. So mortgage growth in California lagged the country considerably last year. And that is starting to come back a bit, if you will. California coming back with a lot of the purchase transactions. So California lagged last year. New York couldn't get loans closed. So those were the two things that really stood out. I would say high bal agency, we're seeing huge volumes there getting done. And then, as Britt mentioned, jumbo loans generally, so that would pertain to your Floridas, New Yorks, Northeast, and the West Coast, Washington. Jumbos, generally people are getting back into that, and hopefully we'll see some cash out activity, right? You don't see a whole lot of home equity loans getting done. So even at these rates, even if rates are up a bit, hopefully you'll see some legs in the cash out market.
Yeah, absolutely. You would hope that homeowners are taking advantage of the newfound equity increases over the last couple of years. John, you made great points as you were giving your takeaways too, just about, call to action for lenders to leverage a lot of the benchmarking related tools that are out there. And I wanted to quickly shine a light before we wrap on FBX Informa's lender benchmark solution. Pair of quick questions on that. How often do lenders that submit data for lenders benchmark receive snapshot outputs on that data?
Sure. Do you want to hit that, Britt?
Yeah, absolutely. Yeah, so the data is updated weekly, every Monday. So every week the lenders have, at any point in time, they have access to the data within the system and through the data feed that they can access, but it's updated on a weekly basis. So every week they're going to be able to see what happened the prior week. So, for example, this week we got the data Monday, QC'd it. Tuesday night, Wednesday morning, you can come in and see what happened through the 18th of April. And when we do those updates, the system also generates a custom PDF report. So kind of like a very high level 20-page, synopsis of what's happened over the last couple of weeks for that specific lender. So it's almost real time, week over week. You can see it.
Excellent. Thank you, Britt. And then last question. Do you segment lenders benchmark data into smaller peer groups based on the overall pool of subscribed lenders that submit data?
Yeah, absolutely. So all of the data within the originations benchmarking is lender blind, obviously, because there's a lot of sensitive information that people wouldn't want to be able to see exactly who's who. But you do have the ability to filter or segment the data. As I mentioned earlier, you can drill down to specific markets, but you can also look at it from hey, I just want to look at financial institutions. So I'm a bank, I only care about banks. Or, hey, I'm an IMB, I only want to look at IMBs, as well as branch versus call center. So if I just want to look at call center volume, I can do that. Or if I just want to look at branches, I can do that. So you do have the ability to segment it out a little bit more to get down to a more granular level that they may want to see.
Awesome. Well, it's great to know. And just a reminder to attendees, we'll also in the follow-up information have contacts for both John and Britt as well, if you'd like to have a direct discussion with either on more about lenders benchmark and maybe how to specifically get involved with FBX Informa there. So on that note, John, Britt, I want to thank you again for your time. I always enjoy your presentations, such great data that you share on different findings across the country. So thanks for putting this together and taking the time to present out to our network.
Absolutely.
Thanks so much, Tom.
Yeah, thanks for having us. Appreciate everyone's time.
Awesome. Well, I hope you guys have a great afternoon and we'll talk to you soon.
Bye.
Thanks, everyone. Bye.